Hi everyone. A few days ago we have posted on the crowdfunding Aurora calculator, which allows investors to compare different loans with different risk grades. It also allows investors to estimate the potential loss in case of default. So in this video we will be calculating the Aurora for the projects for EstateGuru. So to do so we will need the following information. So let's start. So for this video I have selected this loan. So basically it's interest rate at 10%. So we are putting it here. Then we need to understand the probability of default. Given that the EstateGuru is not assigning any ratings, we will use the platform's defaults in total, which is 17.71%. I will be honest, this is very huge defaults because you need to understand, for example, the corporate defaults in Europe are just 3%, even less. But it looks like that this is happening because the EstateGuru is financing only development stage. And if loan, for example, the building is not constructed in defined time, or the project is not sold or refinanced during the maturity of the loan, the project goes default. And I will be honest, I have worked in a corporate banking for more than 10 years and I never saw that development projects have such a short maturity. Like, for example, this loan is maturity only 12 months. Usually it's 5 or 10 years. And therefore, I'm thinking that this is not about the quality of the project, this is the problem of the financing structure. But anyway, default by itself doesn't mean you are losing money. So we need to understand so-called loss given default, basically how much money we will lose if the project goes default. And for this purpose we will have to look on the LTV, and we see that this is for the project 75%, meaning that the collateral value is 25% bigger than the loan value. But let's dig a little bit deeper and have a look on the pre-sale report. And what we see here that we have 4 values. I understand that only few of us understand Latin, but let me guide you through it. So basically we have 4 values. So this is market value on the pre-sale date, and this is so-called forced sales value, meaning that if you are trying to sell this property fast, you will be getting this money. And here it says that if you are trying to sell below 6 months, that basically you are getting 65% of the market value. The next one is future market value, meaning that this will be the value of the property after all construction works are done. And if they are done according to all the standards, building is commissioned and so on and so on. And this one is also the forced sales value for the future market value, meaning after everything is constructed and if defaults happens and you need to sell it fast, you will be getting this money. So if we see here that for the collateral value they was using the future market value, but we understand that if the property goes default, most likely you will try to sell it as fast as possible, and you basically will be getting this amount. And it means that we most likely will lose 10% of our loan. Plus you need to calculate in all the bailiff expenses, sales process expenses. So I would say that to be on the safe side, we need to put 15% at least in loss given default, meaning that we will lose 15% of our loan. And we are ending up with rate 10.3, which is still very good. But just for the comparison, let's try to take another loan. So let's take this one, which is with the rate 11. And yeah, just quickly let's put interest rate here 11 here. Okay, RORAC stays the same. So what we have here, LTV we have 47. So if even we are losing the same logic, that if we will be getting only 60% of the market value, we will be safe. Let's have a look also on a pre-sale report. Yeah, so I see that property is divided in many parts. So if you look on this pre-sale report, we can see that this is the value. The forced value is, yeah, the logic is the same pretty much. But here is the condition. This value is valid only if there is constructed road towards the object. So basically, it's also the value is defined with a precondition. But still, let's assume that everything went smoothly and everything was done. So basically, in this case, we have LGD 0. So, and if we have LGD 0, we see that initially this project had a rate 13%, this had a rate 11%. But if we calculate the RORA, basically it says that estimated real returns will be much higher for this project with a rate 11%. So I strongly recommend do these checks before you're investing. You'll find the link to the calculator in video description, and please subscribe to our channel to not miss the next videos. It's all for now. We wish you a great day and successful investing. Bye.